Welcome back, everyone. Chad Smith and Grayson Blazek here from Financial Symmetry today. And today's topic is based around many questions and misunderstandings we'll get around the ideas of Roth conversions. I mean, this can be an incredibly powerful tool in your retirement tool belt or your financial tool belt, especially in those early years of retirement. And today we're going to walk through an actual example of how and when it makes sense to execute a Roth conversion. And of course, as with any video you watch online, the information is for educational purposes only and shouldn't be taken as individualized advice, as this is best used when it's applied to your individual situation. But we wanted to pique your interest here with what could happen if you're in this phase of life here, which we tend to call the retirement tax window. So when it comes to a Roth conversion, when you're looking at it, that's often the first question is, when should I think about this? When is it beneficial for me to do this? And while the simple answer is any tax year where you are in a lower tax bracket than you expect to be in a higher tax bracket down the road. However, we're going to focus in on this period today. And this is from, 55 and up, right? If you're in an early retirement area, you have a lot of different tools and kind of maneuvers that you could delay, maybe when you're in this period, right? Delay in Social Security, forcing income later in life could allow for Roth conversions during this period at a lower income tax bracket than you may expect. So while we could do a lot of videos on each of these areas, we're going to focus in on the Roth conversion today and how you execute that. So Grayson, you want to walk through a little bit of our example we've set up here?
Yes, we've built an example, somewhat based on client case we've run in the past, but we've kind of simplified the situation. But we're working today with Joe and Sue Aaron. They are both 64 and they're retiring at the end of this year. Net worth's about 3.4 million. 2 million of that is in pre-tax retirement savings within their 401k accounts, as you can see outlined on the statement of net worth there. As they transition into retirement, so into next year, they are both going to have a little bit of pension income, $18,000 each. And the goal or the idea is for them to delay Social Security to age 70. So what we're going to look at today is this window of opportunity, or that retirement tax window, from retirement at age 65 through when they're going to claim Social Security at age 70. And what we'll see is there is going to be a window of opportunity potentially for them to utilize lower tax years to really increase their tax efficiency and really kind of perpetuate their after-tax wealth. And so we've gone ahead and kind of pre-designed the situation for the client. And what we're looking at is how much could they convert each year from pre-tax retirement savings into a Roth IRA for both of them. So today we're going to walk through a scenario where they each convert $25,000 per year over a 5-year window from age 65 through when they claim Social Security at age 70.
Yeah, and keep in mind the pension income is all they have in those years that we've designed. So they have some room there that they could take advantage of that. And Grayson, I know this is one of your favorite graphs here that we tend to walk through, right?
It is. And one thing on the statement of net worth is this client is in a situation where they have some brokerage account funds. So they have some cash on hand, they have some brokerage accounts, because there's always the question of what are they going to live off of during this window? And in this client's case, they have positioned their portfolio to where they're going to be able to pull from a brokerage account or from a bank account to supplement their lifestyle, in addition to that pension income, to allow them to bridge that gap with very little earned, or not earned it, but very little income that's actually going to be reportable on the tax return. Maybe some dividends, some capital gains, plus the pension income. But really in their situation, that's it. And we do understand, of course, pensions are not as common as they were in the past. So potentially it could be they're working part-time. It could be some level of earned income, or maybe they're not working at all and have no pension income. Then the Roth conversion potential is even higher than in this scenario. But this is, as Chad mentioned, probably my favorite graph, because to me, it really boils down tax rates over time. So what we're looking at here, what we're really focused on, is this dark red line. That is their marginal tax rate. So that is the tax they're going to pay on each additional dollar of income that is reportable on their tax return. So this higher amount here at the 22% tax bracket is that last year of earned income. So them entering into retirement during their working years, they were in the 22% tax bracket. And then as you see circled on this chart here, there is this very large window of opportunity where tax rates really drop, because for the Aaron's, all they have is pension income and some portfolio income. And so if they chose to do nothing, in our eyes, that's a missed opportunity, because as they age and as we transition later into their retirement, their tax rates are going to increase, partially due to Social Security starting at age 70, and especially with that $2 million in pre-tax retirement accounts at age 72, required minimum distributions are going to kick in. And you can see on this chart, their tax rate, marginal tax rate, actually jumps up into 25% plus tax bracket. So when we see a situation like this, what we're really trying to do is bring in some of that income from age 72 plus that they're going to be forced to take via required minimum distribution, and actually look to convert it in the early years of retirement at much lower tax rates. So in this scenario, you're converting funds that would be taxed at 25% in the future, and you're pulling it in at 12%. So the delta between these two numbers, it's about 13% tax savings. So as you can kind of imagine, it can be pretty beneficial, but you have to be really careful, and you want to make sure this does make sense in your tax situation. So you have to really deploy a lot of forward thinking and get an understanding of what your future tax rate is going to be, especially once RMDs begin, before you can really determine if a Roth conversion is going to make sense in your situation.
And you can see in our example here, right, that line there is at the 10% level before doing the Roth conversions, and then it pops up to the 12. So we're looking at maximizing that 12% tax bracket in this scenario in the current environment.
Yeah, and the idea is really to smooth out the line that we're looking at here as best as possible. So we're trying to reduce Joe and Sue's lifetime tax burden rather than just looking at a single tax year.
And then there's really two benefits here, right? We're going to look at the first one, because if you can bring in income at that lower income rate that Grayson was discussing versus the higher one down the road, then the first thing it does is lowers your required minimum distributions. And currently those are starting at age 72 for people, right?
Right. So it starts at age 72, and there is a factor or a formula that is going to be deployed each year that you are going to be forced to take a required minimum distribution. And Joe and Sue's case, if they chose to do nothing, that $2 million pre-tax portfolio is going to grow a little bit over this window, assuming market returns. And at age 72, they're going to have to take required minimum distributions of, at age 72, about 115,000, and it's going to vary year to year. But over time, generally, those tend to increase because the factor begins to go down. And so distributions that are forced out, it is kind of matter of fact. It's just a dollar amount that they're required to take out. And regardless of if they need the income or not, the money's forced out, and it's going to be taxable in that year. And so in this example where we talked about implementing Roth conversions over that 5-year window, the first benefit to us is we're actually going to be reducing that required minimum distribution, because the $2 million in pre-tax, you're starting to reduce that bucket of funds by converting it to Roth. And so the RMD factor is based on a smaller gross number. And so in this example, their RMD annually goes down by about, let's say, $13,000 to $15,000 per year. So that's the first benefit, especially in a situation where they don't actually need the RMD to support their ongoing lifestyle. It's allowing them to preserve more tax deferred / tax-free money in either their 401k or in a Roth IRA.
Yes. And so that's the first benefit there. And then a second benefit is creating that tax diversification, right? So Joe and Sue have done a great job of saving in their 401ks, automating that savings through the years and growing that money, also building some after-tax savings. So they have two different tax buckets there that they can use. But what the Roth conversions can do is potentially create another tax bucket there, right, of tax-free money that could be used. Now, this is the example before the Roth conversion, and this is a net worth growth example that shows how their accounts are growing over time. And you can see how it builds up. And on the next slide, you'll see we're using a 5.5% return a year. So of course, in this environment may be conservative for a lot of people, but Joe and Sue are, in a lower risk area of life. So we're using a 60 to 65% stock allocation here for that lower return. But you can still see how those values are growing. But you can see most of their savings is concentrated in those 401k accounts, right? They still have plenty of cash and brokerage account to use there, but there's a lot of their savings, a high percentage that still is to be taxed whenever they pull it out, right? So this is their age when they get up there, in the late 70s, early 80s. You can see how those balances have grown and see how their net worth has grown. But let's look at an example here. If they execute that Roth conversion, you can see two new accounts show up here, the Roth IRAs, right? That they've moved from the 401ks to the Roth IRAs. And you can look at those lines and see how those grow over time. And now you can see that they have that tax bucket where it's basically a little over 730,000 of tax-free money that they used with those 5 years of Roth conversions.
Right. And it's important to remember, if in this example, we converted 250,000 of funds from pre-tax to Roth. Of course, we made some rate of return assumptions, but you can see it can really open up some flexibility in retirement to take distributions from Roth IRAs, and it's going to be a tax-free distribution to cover whatever the expense may need. So it just adds some flexibility. It adds that additional tool to the tool belt to supplement income without having to withdraw from a pre-tax account, which is going to increase your tax burden in the year of the distribution.
Yes, so a nice maneuver. And another caveat here is if you could take advantage of this when the market is down during a recession, that could be an extra added benefit, right? Because then you'd get the benefit of the growth, the added growth in the Roth IRA afterwards. That tends to happen in a recovery. So just another little period to think about there if you're investigating when might be a good opportunity. But this is just one example, right, of how we help clients in dealing with these decisions. And we're a registered investment advisor in Raleigh, North Carolina. We work with over 600 clients. We have a team of experienced financial advisors here. We are fiduciaries, which means we put your interest first, our clients' interest first when making recommendations. And as you may have guessed from the content of this webinar here, that we do take a holistic approach when analyzing client situations and putting their interests first there, and with a particular focus on tax planning opportunities, which is the focus of our call today. So if you would like to check out more info, we have over 500 articles on our blog. You could also subscribe to a podcast that we've done now of 150 episodes, or you could subscribe to the YouTube channel that we have if you don't want to miss our next episode. If you'd like to talk about your specific situation with an advisor today, you could go to our homepage, financialsymmetry.com, and check out the Talk to an Advisor button there and fill out a few things, and that will get you in touch with one of our advisors. So thanks for joining us today, and I look forward to catching you on our next video.